you're definitely not shy when sharing your thoughts about the current market. That you just give a great perspective on everything. What's your take, though? Because everybody we've had on this show, or most people we've had on this show, have been very optimistic about what to expect in the fourth quarter. You seem to be on the other side of the trade here. Do you think this selling is going to be continuing, at least in the short term?
Well, I think we basically are in a classic late cycle dynamic, which is often when you see bond yields start to rise, those bond yields rising affect asset prices, which is essentially what we've seen, over the course of the last couple weeks and quite acutely today. And as those asset prices decline, that creates a weakness in demand and a weakness in economic activity, and is self-reinforcing on the downside as a function of it. And so given the circumstances that we're seeing, I think, there's a significant risk here that we're going to have that sort of reinforcing downward dynamic. And I'd emphasize it's happening at a time when stocks are actually getting more expensive, not less expensive. Today, stocks are more expensive than they were, say, at the beginning of the third quarter, when stocks started selling off, right? And that's very
multiple. What multiple? EPS multiple?
No, just very simply, if you think about it, like stocks are earnings discounted by discount rates, right? And discount rates can be understood. The value of the impact from discount rates can be understood by the performance of the long end bond yield, right? Long-term bonds are down much more so than stocks. Stocks are down 9%. Long-term bonds are down 15% since the peak in stocks. What that means is stocks are more expensive today than before they started falling. And that's a very confusing thing for many investors. How can stocks be going down and getting more expensive? It's because they're not falling enough given the bond yield moves that we've seen.